Goldman, I would argue, has been cautious for most of the summer and maybe getting incrementally cautious. Talk about your worldview right now and how much, if anything, was affected by Jackson Hole.
Well, I think quite a lot. You know, we've had a period where markets have recovered a lot because they've really been seeing bad news as good news, weaker data as being evidence that interest rates have peaked and inflation has peaked, and the relief over interest rates has really helped long duration stocks and equities to rebound. But now I think we're moving into a bit more of a phase where investors will reassess that balance. Stronger data may mean, and we've heard from Jackson Hole, a little bit more of a hawkish spin on the prospects for interest rates and the possibility that they'll stay higher for longer. And that, I think, is going to weigh on equities. So I think we've seen a bit of a premature recovery from the bear market lows on the hopes that rates will come down. And this is going to enter a period of more choppy, challenging assessment of that balance between rates and growth.
Right. As we try to assess the path of inflation from here, is it fair to say that the U.S. is in a better position vis-a-vis Europe?
I think it is. First of all, the US doesn't suffer from the same problems in terms of surging energy and gas prices. Of course, it's buying things in dollars, and the dollar is very strong, whereas across Europe, you're seeing a weak currency resulting in higher inflation being imported. So I think the pressures are more moderate in the US, and we've got significant challenges still to come across Europe in terms of higher inflation, bearing in mind, of course, that interest rates are still at a much lower level. So in that sense, there's more work to be done.
But Peter, Sarah, haven't you guys been recommending going overseas to the equity markets outside of the U.S., even though the U.S. has been outperforming?
Well, selectively we have, and in local currency terms, we've seen some reasonably good recoveries in other markets as well. But of course, in dollar terms, that hasn't been true because of the dollar's strength, and that has really offset the effect of improvements in other markets for dollar-based investors. But I think it is right to say that the recession risks are bigger outside of the US at the moment, particularly across Europe and UK. But bear in mind, of course, markets are a lot cheaper. And actually, you know, earnings results have been holding up as well in Europe as they have in the US. So I think selectively there are some good opportunities outside of the US still for investors.
Overall, Peter, in the stock market, is there a mispricing of the risks here that we're looking at related to the economies and potential recession, given what the Fed and the ECB are saying, given the fact that they are doubling down on tightening with an inverted yield curve? What's that going to mean for the economy, and is that reflected in the stock market?
Well, I think in recent times, the recovery that we've seen from the June lows has reflected this growing optimism on interest rates in particular. And after all, it was rising inflation and interest rates that really triggered this bear market. But I think investors have been a little bit too complacent about how quickly interest rates and inflation will come down, and also how resilient the economies will be. And something's got to give. You know, either rates will come down earlier, but that will be on the back of weaker growth, which will weigh on equities, or indeed rates and inflation will be higher than the market has been recently pricing. So I think this is likely to weigh on investor sentiment, particularly after the strong rallies that we've seen through the summer.